Welcome back, Metropolis Talks, Mortgage Unplugged. This week we're going to be talking about something that's very important. We've had several calls and inquiries about how this aspect of the mortgage works. We have Jacob with us from Outline again. Join us.
Hello.
Welcome back, Jacob.
Thank you.
I'm going to jump right into it. Down payments and hidden costs. They can be up to more than 5%, not just 5%. Would you elaborate on educating on minimum down payments, maybe some aspects of the CMHC insurance program and closing costs? They are becoming big burdens, and there's a lot of fuzz around how much you should save for or what you should look out for, or any areas that you could shed more light onto.
Of course, yeah. When it comes to advising my clients, the mortgage is one thing, and technically closing costs are not part of the mortgage piece. Right. But overall budgeting and making sure that my clients do have the funds that they need to close and do have the funds that they need to carry the mortgage on a monthly basis, I feel like is a part of my job in advising my clients. So it's definitely something that comes up quite often. First, to touch on the down payment piece. So the minimum down payment, as it stands today, is 5% of the first $500,000, and then 10% on any amount above that, up to $1.5 million. Okay. Any purchase over $1.5 million needs a 20% down payment, no exceptions to that. So you could potentially purchase a property of at 1.2 or 1.3 million and still have less than 20% down. It works out to about 7 or 8% down, right. But it's 5% on the first 500,000, which would be $25,000, and then 10% on any amount above that. Okay. When you're purchasing with less than 20% down, you need what's called mortgage default insurance, or more commonly called CMHC insurance. Yes. There are 3 insurers that provide this insurance. CMHC is one of them, and the other 2 are Sagen and Canada Guarantee. And basically, they each have their own guidelines and nuances, but their programs are basically the same. It's not really important who you get the default insurance with, and it's not really important for you to run the calculations yourself, because it's something that I do in the background, something that the lender does in the background as well. Very automatic, and when you are purchasing with less than 20% down, it's something that's factored in right away. The way the cash flows is basically you're borrowing the money to pay the insurance premium. So your insurance premium could be anywhere from $5,000 to $30,000, just depending on your price point and your down payment. And that amount is added to the mortgage. Okay. So you're borrowing that, yes. And then it's paid to the insurer right away. And then basically it's part of your mortgage balance, and you pay it off over the lifetime of the mortgage. That's kind of how the insurance premium works.
And that is mandatory in Ontario?
Yes, yeah, across Canada.
All the way across Canada. Yeah. Okay, so that's not something that you can get away with, because there are, we were talking earlier before the podcast, that there are properties around the globe that do not run this program. And I've been saying this ever since I came to the country. I think for Canadians, I live in Markham, so in Ontario, for this province at least, we are very heavily regulated. A lot of compliance comes into it, code of conduct, so you've got to make sure that you're hitting that benchmark. And these do safeguard you. I think it's more for the consumer to be able to understand why they're making these payments, rather than having that hefty bill at the end of the closing on your statement of adjustments to see, oh my goodness, what's happened here. And again, I've been reiterating from the beginning of the podcast to align yourself with the correct expert to be able to guide you on those aspects, rather than have surprises, is so crucial, especially if you are a first-time home buyer.
For sure.
So there's a myth that says you can't buy a home without 20% down. Is that a myth you're going to bust?
Yes, myth busted. The rules are currently, if you're purchasing a property as your primary residence, yes. You can purchase with less than 20% down, even if it's your second property or third property. So a lot of people think that that's kind of their first-time buyer benefit, is purchasing with less than 20% down. But the rule is, as long as you're going to live in that property yourself, you can purchase it as an insured purchase or a purchase with less than 20% down, because it's going to be an owner-occupied property or a primary residence. So for example, say you're a first-time buyer, you buy your first home, and then you decide you're going to convert it to a rental and buy a second home and live in that second home. Right. You can purchase that second home with less than 20% down, because you're going to occupy it yourself. So those are the rules as it stands. If you're purchasing a property as a true investment or true rental, it has to be 20% down.
Right. So there are nuances in there. And obviously this is all assuming that you hit the threshold for the income aspect of it as well.
Yes,
it's not just where I would walk in and I'm earning a certain amount of income and I'm trying to qualify myself for $5 million. you've got to obviously be realistic with those numbers too, and they align.
For sure.
So I was reading an interesting fact the other day about Toronto. An average closing costs can range from 1.5% to 4% of the purchase price.
Mm-hmm.
Would you say that was accurate?
I would say for sure. Yeah, the biggest piece of your closing costs is land transfer tax, which is something that we didn't touch on yet, but I think is very important to bring up. As you mentioned, that final line on your statement of adjustments could be a little bit shocking. The majority of that cost is land transfer tax. When you're purchasing within the City of Toronto, there's 2 land transfer taxes payable, one to the province and one to the city. If you're purchasing outside of the City of Toronto proper, then there's just 1 land transfer tax to the province. So as you said, within the City of Toronto, the land transfer taxes can be quite high, and it's based on purchase price. So the more expensive the home, the higher the land transfer tax is going to be. As a first-time buyer, you get a discount to the land transfer tax. So within the City of Toronto, you can have a maximum of $8,475 discounted from the land transfer tax. So that's a good chunk of change that first-time buyers don't have to pay in order to get into the market for the first time. But that's one of those benefits that is when you use it, you lose it, and that's it. It doesn't come back around. Again, like the purchasing with less than 20% down rule, you get it once on your first property, and that's it.
And then what happens then if you're 2 people purchasing it, one of you is a first time and the other isn't? How does that work?
Yeah, so it depends on the ownership structure of the property. So if you're going 50-50, then you could get half of the land transfer tax discount. Just make sure to consult your lawyer to make sure you do qualify as a first-time buyer, because if it's 2 partners purchasing together, but you were living with that partner in a home that they owned, there are nuances there that may take away your land transfer tax discount. So just make sure to chat with your lawyer, because they're the ones who have the final say as to whether or not you qualify for the discount.
Right, and I think it's very underrated where people refrain from paying lawyer reviews, and I've seen that in so many different cases, Jacob, you wouldn't believe. I've had clients literally walk away, and a lawyer review is quite nominal when you're comparing it in comparison to the amount that you're purchasing the property for. And so I think that's important. Once you've had that reviewed by a lawyer, a licensed lawyer in Ontario, then at least you know what you're budgeting for, because really you're budgeting for the move, not just the mortgage.
Yeah.
And I think people forget that at times.
Yeah.
So as a closing for this week's on down payments and hidden costs, etc., that we've been talking about, anything else that you would like to add?
Yeah, just on your point about the lawyer, I think that you can do your job as best you can, and I can do my job the best I can, but at the end of the day, the lawyer is the one closing the transaction, and you need to have somebody that you trust, somebody that's accessible on the legal side, but also, like you said, doing that due diligence up front to make sure that everything is going to go the way you expect it to, and your budget is on track for what it realistically should be. I think it's incredibly important. So being in touch with the lawyer earlier than just like the last minute is a smart thing to do, for sure.
Right, and I agree. We have in-house lawyers, and I'm not promoting them. The amount of work that is done, and the scheduling that we do to make sure that we contact the client before the date actually comes up, notifications that are sent out are so crucial, and that really does become a benchmark for us. That's something that we work towards, making sure that we communicate with the client regularly, making sure that the whole process is seamless for mortgage agents and other experts that are involved in that transaction. So great, thank you very much. Thank you for being here. I hope you enjoyed it. We'll see you next week. Take care.
Bye-bye.